Welcome everybody to the March 2022 market update with Jolene Moore. I'm Cindy Bishop with Cindy Bishop Worldwide, and I want to introduce you to Jolene Moore, your presenter today. So for those of you that don't already know Jolene, I think I just said a bunch before we hit the record. She's the vice president and senior home loan consultant with Main Street Home Loans. She's also a top producing, top tier lender and one of the most sought after for her care and diligence to her agents and consumers. And Jolene has a lot of skills. She chews on humble pie, so I'll take a minute to tell you what she does. She's a very, very good financial planner, and as a matter of fact, I use her forms. I think they're so simple and they're so easy to do, and that's one thing she'll be providing in her next class, which we just discussed. Also, she is amazing on business building. The things that agents learn and implement to do more than just get information on what a mortgage loan officer knows. She actually helps you implement the business building end of it, and it's just really powerful. So in addition to all that, anyone that has been in any of her trainings, I can tell you, has already seen the value. I get unbelievable testimonials about Jolene, and I have probably said enough. So let's let Jolene get going on what we've all been waiting for, the March update in the market. Take it away, Jolene.
Thank you so much, Cindy. Thanks everyone for hopping on today. I appreciate it. So, you know, again, I think I see familiar names and others that don't, but basically I'm just going to share information about the market. I have the chat box open. So if you have a question or a comment, please feel free to put it there, but also feel free to unmute yourself. I love interaction. So anything you want to share or ask me about, I am here for that. So, interest rates is usually always how I start because it's always a, top of mind and always one of the most frequent questions I get. So 2022 is really started out very interesting. There's been a lot of volatility each week. It's, there's just, you never know what's going to happen, unfortunately, with interest rates. We'd seen them shoot up, I think we started in 2020, January 3rd at probably 3.125. We got up to like 4.75, 4.5, something like that. We did come down a little bit over the past couple of weeks, and then Friday and today we've seen the market worsen. So, that's what we're seeing is we might, shoot up, then we'll come back a little bit, and then we might go back up. There's just been a lot of volatility happening. A lot of it has to do with inflation, the Fed's selling their mortgage-backed securities and not buying so many mortgage-backed securities, the war that's starting as well. So all of those things, we were normally in this situation when there's like economic unrest because of global activities that would see our interest rates improve, and that's what we had started to see over the past week and a half. But then some concerns have come out. Again, the job reports came out on Friday. So things like that, economic reports are going to come out, and that's what's going to cause our volatility. So there's just so much unknown that, if I have a client that I'm, we're under contract, I would definitely not look at floating anybody. We're going to start, lock them, get the process started as soon as we can so that we can secure the rate for them. And the good news is us, my company, we do have a float down option. So just as an FYI, if you have clients that are in this scenario and they're worried, what if the market improved? Odds of that are not great, but should it happen, we do have the ability to float the rate down. Usually what I tell clients is if it improves by 0.25%, we can float the rate down at no cost. So that's why it's, better to secure it rather than the unknown of what could happen. All right, just sharing some market statistics. Home prices nationwide rose, pretty significantly again in January by 19.1%. And that was pretty, in our area, I think it was pretty similar to that as in the Northern Virginia area. But the National Association of Realtors did report a decline in contract signings in January. So it was down 5.7%. So that obviously means, for February, March numbers, we could see a little bit of a lower amount. The median price did increase by 3.2%, according to Northern Virginia area from January to January 22 or 21, I'm sorry. New listings, which is a lot what drives, you know, the escalation clauses we see and the waiving of all the contingencies and all that kind of stuff, is because our inventory, as we all know, is super low, and it was down even further in January by 23.5% from the previous January. Inventory, you know, in general, is down about 46%, so almost 50%, which is insane. Our average sales price in our area actually increased only 7% in January. And then I've talked about this in the past, but the feds, you know, are going to be meeting this month. They're anticipating raising their rates. Part of what happened last week is because of what's happening globally. The prediction was that the feds were going to raise their rate 0.5%. But after all this unrest that's going on, they are now saying that there's a bigger prediction that they're only going to raise 0.25%. So in the market size, that's not a good thing for our economy. So that's why our rates are shot up and worsened after the idea of the feds actually not increasing as much as we thought they were going to. Because when they raise their rate, they're doing that to stave off inflation. And as we've all seen, you know, everything we're paying for right now has really moved up. So they, you know, the market wants them to try and start helping inflation and start getting that to drop. And the way they see that they can do that is by raising rates. I went over that last month and kind of how that cycle works. The one thing I was also noticed is in the past, like I've been tracking this for almost 2 years now, I would say average cash sales in our area over the past 2 years has probably been between 11 to 13%. So that in January, it was a little bit higher at 16%. But I will tell you that I just went to visit, I have a coach, a business coach, and I went to visit him yesterday in Tampa, Florida. And he was telling me that their cash sales are like 40 to 50%. So if you think that we have it, you know, like you feel like, oh, we're always going up against cash. Reality is it's about 16% of our transactions. And if you're in Florida, in Tampa, Florida, you'd be going up against a whole lot more. So we can be something to be grateful for in our market, that we don't have as many cash sales as we feel like we could, you know, and it feels like we do at times. Anyone have any questions regarding any of that, any of the statistics, anything they want to share? I'm always open to it. So something that was just announced by Fannie and Freddie is they had been doing this, but they're kind of making it, I guess, more prominent, is we could see desktop appraisals. So I did a video last week on property inspection waivers, which means that, you know, when we run it through our automated underwriting systems for Fannie and Freddie, we can find out if we get a waiver on that property and not have to do an appraisal. Now, for a purchase transaction, it's limited to 80% or below on the loan to value, and it's only on a purchase for a primary and a second home. So what they are now doing is they're also going to be implementing desktop appraisals. And what desktop appraisals means, it's an appraiser that's going to evaluate the property, but they're not going to go to the property. So they don't have to go out and take pictures and go see it and all that kind of stuff. It's basically done on their desktop, right, on their computer. They're going, so what happens is when we run it through the automated underwriting systems for Fannie and Freddie, they will tell us whether or not it's approved for a desktop appraisal. And in order for us to get those, it's going to be based on a primary residence and 90% loan to value. Now, it's not a waiver where, you know, the value is set and we know it's going to come in at that, but it could improve on our timing. Because obviously the appraiser doesn't have to go out to the property and take pictures and all that kind of stuff. So it could shorten the window of getting an appraisal back. The unfortunate thing is appraisers have told us they're not going to charge any less, which doesn't really make any sense. But unfortunately, that's what appraisers are doing right now. So the cost is not going to be any different, just as an FYI, but it could help speed up the time. So we'll keep you posted on that and how that evolves as time goes along. Model home lending. I think I mentioned this, but I want to just reiterate it that we do have an investor that if you have new construction and you have a client that's looking at the model home, but the builder wants to continue to use the property and rent it back from the buyer, that we do have an investor that allows us to do that for up to a year and do it as a primary residence. Because normally, as we all know, you have to occupy the property within 60 days on a primary residence, but this particular investor allows you to do that up to a year. The increase that I've been talking about for second homes and conventional loans, which are between that 647,200 to 970,800, there was a price that went into place, price increase on interest rates for that. And then all second homes, not relative to just that loan amount, that has started. The one thing I will tell you that the price increase that we see on that conventional loans between those loan amounts, the good news is if they're a first-time home buyer or they make less than 126,000, they would not have the hit to the rate. So we just had a new construction that was getting delayed by quite a bit, and they were going past the date of that implementation of that hit. And we were, trying to figure out they were going to have to pay that money, or raise the rate. But then we realized they're first-time home buyers and they make less than 126,000, so they no longer, it was not going to impact them. So something to keep in mind as well. We also have a lock and shop program. So as we're talking about, rates are volatile. There's a lot of concern of like what the history or the future looks like. So we have the ability to lock up to 60 to 90 days. Basically what that means is we're locking the loan while they go and look for a property. The challenge, there's some, limitations to it. Obviously there's 60 days, 90 days, the rate's about an eighth higher than what it would be at 60 days. The loan amount, what we lock in can't change more than 10%. There can up or down. So we have to be very focused and know, very well what that price point is going to be and what the loan amount is going to be in order for us to be able to use that program. There is no upfront cost to do it, but it's going to have to be that the person is committed to working with us, because it's obviously going to cost the company money, and that, there's the expectation is that they're going to be finding a home within that time period. So there's some things that we can talk about further with that with clients that are interested in it, but I just wanted to let you know that it's out there and it's available. The other thing is self-employed tax season. As we know, taxes are coming, everyone's starting to work on it, get those taxes done for our April 15th deadline. For self-employed borrowers, the good news is I mentioned before that the COVID overlays that they had for Fannie and Freddie have been removed. So we are very focused on just tax returns now. But keeping in mind that, when you have an income of 100,000 and you write off 50,000 expenses, we can only use 50,000 for qualifying. So, and if they file their 2022 or 2021 taxes, we have to have either proof that the IRS has processed that return or something showing that the IRS has received it. So again, if you have clients that are in that situation, feel free to reach out to us, but we want to help navigate them through that so they put themselves in the best potential situation to be able to buy a home, this year, if that's what they're looking to do. So anyone have any questions on any of that besides a shock that I think I already answered? All right. Personal property. So this is something that comes up a lot for us. A lot of the contracts that we get, reflect personal property. So I know that the contract in Virginia was just changed in January that says, there's no no value associated. It's only for the seller convenience. Unfortunately, our underwriters have continued to ask us for an addendum to get that personal property removed and say there's no value. I've asked them to reach out, to Fannie and Freddie and see if we can get clarification on that to make sure that has to continue. So I will keep you all posted on that, but that's something just to be aware of, that we may still have to ask for that addendum, even though the contract says it. But I'm working on that. These are this kind of bullets here is kind of what I've learned over the past month, things that we've done with clients, and sometimes not everyone's aware of what can happen. So just want to let you know that, you can close a VA loan, when you're selling a home that has a VA loan and then a new VA loan on the same day. So there doesn't have to be a waiting period, for us to be able to get that eligibility open to be able to be used. I had a client this past month that lost their job during the loan process. We were able to add a non-occupying co-borrower to the loan to help him to continue to qualify, and we still closed on time. So those are just things to keep in mind if you have situations like that, or if you have, a lender that doesn't know how to do that, please feel free to reach out to us. Something we've been seeing quite a bit this month is low appraisals. So as we all know, the appraisals, the offers are being submitted with over sales price. We're waiving contingencies and waiving appraisal. So what that means is, what we have to do is when we have in a conversation, when I, get someone pre-approved, I try to have the conversation with at the front, letting them know about the appraisal waiver and what that contingency looks like. If they waive that contingency, what it means that we still have to do an appraisal. What does the agent, think that the house is going to appraise for, what versus what they're paying for, so that we can help to prepare them like, okay, here's what you could be looking at based on those numbers. And then obviously updating it once we actually get the appraisal. So we had one that came in $7 low. We had one that came in 60,000 low. We've had 10, 15,000 low. We had ones that people thought were going to come in low and didn't. So that it's kind of all over the place. So, but it's something you definitely want to make sure your clients are having those conversations about from the very beginning about low appraisals and what does that mean for them. There's situations like I had one that came in 60,000 low. It didn't change their cash to close and it raised their payment about $120 because we had to add on mortgage insurance. But that mortgage insurance is going to go away in 4 years. So it wasn't a thing that they didn't feel like they could recover from and that they were comfortable continuing to move forward. But we had prepared them at the very beginning of what that could look like. So I highly recommend that you are working with someone that is doing that so that they can help prepare. We call it an appraisal gap strategy. We have, scenario, we use a system called Mortgage Coach, and we show side-by-side comparisons of like, here's what it looks like if all goes according to plan and it appraises for what you paying for it. But if it doesn't, here's what it looks like if the appraisal comes in low. So again, if you have any questions on that, feel free to reach out. The other thing I wanted to mention, is we have a follow-up plan on pre-approvals and leads. For pre-approvals, we have a 42-week follow-up plan. And the reason why I bring that up is kind of like what Cindy mentioned, is one, I want you to know if you chose to work with us, what that looks like, but two, to make sure that you have a system in place as well for following up. Because I will tell you, some of the transactions that we closed last month were from clients that I talked to a year ago. So because we stayed in continuing contact and we followed up with them periodically, as well as their agent, we were able to, continue working with them a year later. So it's very important for you to have systems in place and tracking your leads and follow-up plans and all of that to make sure that all of those leads that you stay in touch with them, whether it's now or next year that they look at buying. The other thing I wanted to bring up, so we have seen a lot of quick closings. So just like we've seen a lot of waivers of contingencies, we've also seen very short closings. So I had my team run a report because I was just very curious to see. And all of our loans that we've closed so far in 2022, the average time period it's been in processing from when we started the contract to when it closed was 17 days. So that is amazing. It's crazy to think how quickly all these loans are closing. So again, that's something obviously that the agents I work with have found it to be helpful for us to be able to close quickly to help them be successful with their offers. So something to keep in mind, for you and anyone that you may be working with is, it's possible, it can happen. And those are things that could potentially help you win an offer. Anyone have any questions? So as Shock said, for an extension of lock fee, unfortunately, we cannot extend the lock and shop. So that's why we have to, it's going to be select clients that we're going to do that with. It's not something we're going to do a lot of because of that very reason. So there is no extension, unfortunately. All right. Anyone have any questions?
Yeah, I have a question, please, Jolene.
Hello?
Yeah, I said I have a question.
Sure.
So how you guys can close in 17 days if there is like a process like the appraiser? I know that the appraiser takes like 10 days or more to come back. So how you make the process fast by closing only in 17 days?
Well, one, we can order the appraisal as a rush if we need to. The other thing is like if we're closing in 14 days and we get the appraisal in 10, we can still close. all we have to do is review the appraisal, and then if we have to make any adjustments. But, usually on a 14-day close, we're going to order the appraisal as a rush and get it back. We've got them in 3 days, 5 days, 7 days. So we'll do what we need to, to accommodate the contract.
So since the appraiser is being paid by the buyer, so if you order it as a rush order, it's going to cost him more to do that?
Yeah, it's about $150.
Thank you.
Mhm. Anyone else have any questions? All right, well, that's Cindy, did I cover what you were hoping to see? Because you were mentioning.
Yes. I think
Yeah.
that's I think that was really great. And the recording will be on Jolene's instructor page and on our blog at cindybishopworldwide.com. And just so you know, that's what I do with these, so you can watch them again.
All right, I'm gonna take a quick picture. I'm trying to do better with my social media, so let me take a picture.
Okay.
All right, everyone, have a great day. If you guys need anything or have any questions, reach out, and I hope you found this useful.
It was. Thank you, Jolene.
Okay,
Thanks,
take care.
Jolene. Bye.
All right, bye-bye.